Hi everyone, it's Rich Warner from WealthMaxBuilder.com. Welcome to Lesson 3, entitled Dubious Investment Ideas You Should Avoid. Now the list of dubious investment strategies is quite enormous, as you can imagine, but I decided to narrow it down to 15 investment strategies or ideas that perhaps may not be the best idea for individual investors, especially passive investors. As always, please have a moment to take a look at the copyright notice and the disclaimer statement. You can pause the video if you so choose. Thank you very much. So as you can imagine, as these pictures suggest, and the second one is from Boiler Room, the movie, there are many ways to dress up dubious investment strategies to make them look like they're ideal for you as an individual investor. And some of them are not necessarily schemes, but they're just complicated or so-called advanced strategies that I don't think fit into the individual investor's toolbox. As mentioned, we're going to cover about 15 dubious investment strategies in this video lesson, but I decided to break it down into small parts because I could spend a whole year just talking about these dubious investment ideas. So the first video lesson here, 3.1, 3.2 if you will cover individual stock picking and bond picking and also value investment strategies. Let's get to it. So the greatest risk when it comes to picking individual stocks, of course, is if the company goes bankrupt, which, as we've seen in the past with, for example, Enron, the stock was trading around 90 in August 2000 and eventually went to zero when the fraud schemes and the accounting schemes started to become public, and it became fairly clear that this was just a fraudulent company, and investors essentially lost all their money, those that held on to the very end. This is the greatest risk of picking in an individual stock. Now, of course, not all stocks go to zero, not all companies go bankrupt, but there is certainly something to be said for owning one or two or three stocks and the risk of extreme price movements. Negative news can impact the economy or that particular industry or that particular company. And the more you're exposed to a limited number of stocks, the more volatile your portfolio will be. And the way you can address this and reduce the volatility of your stock allocation is by buying an index fund. You can buy the S&P 500 in one shot, 500 of the largest large cap stocks in America. So with $250, you can get instant diversification across 500 large cap companies. The same holds true for the QQQ. For less than $50, you can get instant diversification to 100 of the top technology companies. You don't need to bother with picking individual stocks. What this chart is showing here is that the more stocks that you own, the more diversified your portfolio will be. So you're not putting all your eggs in one basket. You're putting them in multiple stocks. And the more stocks that you own in your portfolio, the more you approach what is known as the stock market risk or systemic risk, the risk of the broad market itself. Another way of showing this concept is by comparing implied volatilities of the stock index itself, S&P 500, which has an implied volatility of 15.5%. The Cubes or the NASDAQ 100 Technology Index has an implied volatility of 17.5%. which is slightly higher than the S&P 500. And then if we go to these individual issues, these individual companies, their volatilities, notice, are much higher than the indices. And that's to be expected because there's individual company risk and industry risk that is not as pronounced as when you own the broad market index. Just as a side note, implied volatility is related to historical volatility. Historical volatility is where we get standard deviation from. Standard deviation is a backward-looking statistical concept. It basically takes the price movement in the past into account relative to the mean, and it shows just how extreme those price movements are, backward-looking. Whereas implied volatility factors in the historical volatility, but is also trying to be forward-looking. So if you have a big economic report or a news item coming out about a particular biotech company, a big decision that's going to affect an industry, say, and it's pending over the next 2 weeks, well, you would expect the option implied volatilities for that particular stock or industry to be much higher for the next 2 weeks, and then after that you'll notice that the implied volatilities on the far dated options contracts are lower than the nearer contracts. So implied volatility is determined by the option players, the option writers, and the option buyers. Supply and demand, they're buying and selling these risk premiums. Options can be considered to be a form of insurance on the underlying security. And so implied volatilities will fluctuate based on not only the past behavior of this particular company or the market itself, but it will also try to anticipate future price movement as well. So as an extreme case, here's a smaller cap company, COGT. It has an implied volatility of 150%, which is enormous. Another smaller cap company has an implied volatility of 65%. Another example of an individual company's implied volatility is Intel, the chip maker, the semiconductor company. It has recently exhibited an implied volatility of 26%, which is noticeably higher than the Cubes, which is the NASDAQ 100 technology index. I'd like to also say that the risk of default is definitely present not only for stock investors, but also for bond investors. This is a chart, for example, that shows the percentage of defaults among high-yield bond issuers. So these are non-investment grade companies, corporations, governments, and municipalities in some cases that are issuing bonds. And notice that during recessionary periods like we had from 2000, 2002, and then 2008, a financial meltdown period, the default rates for these high-yield issues increases dramatically. As you can see, the default rate for these high-yield issues will approach 14% in very bad times, which is quite high when you think about it. So about 85% of the high-yield issuers avoid default. And default basically means that the issuer, whether it's a corporation or a government, can no longer afford to make the interest payments on its loans, on its bonds, or repay the principal. Recently, we have seen how the price of municipal bonds from Puerto Rico has declined in value. And you can look at the price of the bond as a bet on the potential for a particular issuer to repay its principal. So as you can see in 2015 and 2016, the possibility for default was increasing dramatically and the price of the bonds had gone down. When I started out as a financial advisor many years ago, I learned a powerful lesson about trying to pick individual bond issues. I'd loaded up on Ford bonds because to me it seemed like it was a stable auto company and it was yielding like 7% at the time, which was about 3 percentage points higher than the Treasury bond market. As you may recall, the auto industry in the United States around 2006, 2009 was going through some very harsh times. And during this recessionary time period, the prices of a lot of manufacturing auto stocks went down. And GM in particular was hit very hard, and GM eventually went bankrupt in 2009. Well, fortunately, I didn't own any GM bonds, but I owned the Ford bonds, the Ford Motor Credit in particular. And during this recessionary time period, I watched the price of the Ford bonds go down pretty significantly, but fortunately, they never quite reached default, and they came back and eventually went back to par, and my investors got their full principal back and the interest as well. You could say that I dodged a bullet in that circumstance, and I vowed from that point on never to try to pick individual bonds, let alone stocks. There are definitely safer alternatives. You could pick a bond fund that is diversified across hundreds of bond issuers and have billions of dollars under management. There is no need for you as an individual investor to go out and look for individual issues. It does not make sense. It is not worth the risk, believe me. And you'll save yourself a lot of anxiety that I was experiencing on behalf of my investors at the time. And I said that this would never happen again. I would never put any of my investors or my own money in an individual bond issue. I will stick to bond funds from now on. Now let's move on to value stock picking strategies. You know, value has gotten a very good reputation, especially in view of Warren Buffett being a value investor. Benjamin Graham's Intelligent Investor book, for example, is like the Bible of value stock picking. And there's something to be said for value stock strategies, no doubt. But I think most investors make this huge mistake in assuming that value screens are going to protect you in a bear market because your portfolio is comprised of value stocks and therefore they shouldn't go down as much as, let's say, growth stocks. When in fact, in 2008, as you can see from this table, value stock screens were down 36.4%. Meanwhile, growth screens were down only 35.5%. So growth actually outperformed value in 2008. I'd like to just also say that, you know, Warren Buffett's Berkshire Hathaway was down over 55% between 2008 and 2009. That is a huge drawdown. And I don't think many investors out there, except for a few like Warren Buffett, can sit through a 55% drawdown. You try doing that sometime, and you will feel so dismayed and you'll feel so frustrated that you won't even want to go near stocks anymore. That is a fact for most individual investors. Individual investors cannot sit through a 25, 30%, let alone 50% drawdown. It's just too much to ask for. And quite honestly, most hedge fund managers out there who suffer through 55% drawdowns will get fired. There's just no way that you can, at a hedge fund, that you can put your investors through a 55% drawdown. You will lose investment assets immediately. I'm amazed that a lot of investors actually stuck with Warren Buffett through this period. This is nothing to knock Warren Buffett. He's much wealthier than most people, including me. But to ask individual investors to sit through a 55% drawdown in a stock fund, I think is asking for too much. The only place to hide in the bear market of 2008 was the Treasury bond market. As you can see, the ETF, Exchange Traded Fund, IEF, which is an intermediate Treasury bond fund, was up almost 18% in 2008. Now that's the way you want to protect yourself in a bear market. You do not want to assume that value strategies are going to be there for you. In 2008, it was a very scary period. I just like to just mention one more thing. There was not a single stock screen out there, whether it be, you know, value, growth at a reasonable price, otherwise known as GARP, PEG screens, CAN SLIM, some of the better earnings surprises, you name it. These screens, none of them were positive in 2008. They were all down. It was just a matter of how much were you down in 2008. And as we saw, Buffett's Berkshire Hathaway was down over 55% between 2008 and 2009. That's quite severe. And so the point is that don't look to value screens for protection in down markets. It's not there. In order to protect your portfolio from downward moves, you need to have some allocation to investment grade bonds. And in particular, you need to be invested in Treasury bonds to a certain extent. So to sum up this first section of video lesson 3, I'd like to just say that investors cannot rely on value stock picking strategies to preserve capital in bear markets. The only way to offset stock risk is to allocate a chunk of your portfolio to U.S. Treasuries and investment-grade bond funds. Well, that's it for this section. I hope you enjoyed it, and I hope to see you in the next one where we're going to talk about convertible bonds and dividend capture rapture strategies.